Hello guys, welcome back to the channel, and today we have a fundamental analysis of a stock of the stock called INFOBEANS. The firm is a IT services company. It is a very small cap stock and it has huge growth potential, so we will be doing a fundamental analysis on it. We'll be going through the what the business model is. We'll be going through the financials, the shareholding patterns, the management, and also we will be listing out what the risks and negatives associated with this are. So this stock has had consistent financial performances, and it has a quality management and strong technical momentum also on the technical charts, indicating that there is a good investor enthusiasm in the stock. So during the last year, this company has grew its earnings per share, the EPS, by 45%. So the share price gain is also 118%, 118%. So which has certainly outpaced the EPS growth. So it is fair to assume that the market has a higher opinion of the business than it had a year ago. So the company is also reinvesting heavily into its business and at a very high rate of return. And unsurprisingly, this has led to an impressive earnings growth recently. And if the company continues to grow its earnings the way it has in the recent past, that could have a positive impact on share price, given how earnings per share influence the long-term share prices. So basically, the company is reinvesting huge amounts into the business. It is in a growth stage. It is investing a lot, and all this will be evident as we go through the financial statements, that the company has huge growth potential, but also with huge returns come huge risks, and we will also be going through that. So the business model. So the company mainly has six main businesses. These are three of those. So digital transformation partners. So basically this company helps other firms take their businesses online. So for example, if you knew DMart had retail stores before, and now they have set up their websites and they are running an online business as well. So how will they do that? All that. So running an online business, taking an offline superstore to an online platform is not a simple job. You will need professionals in that particular areas. So these IT services company, and this InfoBeans is also one of those, helps those offline companies go to the online mode. And so that basically means digital transformation partners. So they cover the end-to-end execution of digital transformation, from leadership level strategy to the on the ground implementation. So that is their digital transformation partners. This is their main business. So they also have other businesses like product engineering, bring together the expertise, operating models, and technology required to design, architect, develop, and manage your product lifecycle through efficient delivery, faster time to market, innovation, and differentiation in competitive markets. So again, this in simple words again basically means, I'm stressing on this part again and again. So these companies, let's say IT service companies, help offline companies or stores go into an online mode. Like you have your Shopper Stop or Pantaloons also. Before they were mainly operating on retail stores, the big outlets. But then as the pandemic hit, you saw them set up, online websites and running their business online. So running a business online doesn't just involve creating a website. It also involves a lot of other aspects like the delivery, and as you are giving them delivery, you also need to look at your profit margins and see that part doesn't come down heavily. But then as your delivery costs are increasing, your maintenance costs are also decreasing, as the store cost will be lesser. And the workforce you need will be hugely different. So here in an online mode, you will need people for delivery, or you will hire third parties to deliver those items to the customer. But in an offline mode, you will need salespersons at the store. So again, all these things, the companies go to firms like InfoBeans so that they can guide them and take them online. So, and Salesforce is basically, again, same thing as I told till now, is basically related to that. Now, ServiceNow. So ServiceNow provides a framework that describes, organizes, and automates the flow of work. So the flow of work in a firm is basically different for an online and an offline mode. So this team helps them, shift from this one mode to the other. And cloud. So cloud is one of the fastest growing, you know, elements out there. So what basically cloud means is that we're storing data from hardware to software. So what that basically means is when you store huge amounts of data, so you cannot store when you're storing small amounts of data, you can store in a pen drive or hard disk or whatever at your home, right? But when the data becomes more and more and it keeps increasing, so you cannot maintain physical data in physical forms, right? So cloud is basically where companies help you take that data and store it there, and you can retrieve it whenever you want, and also this company helps them with that. And automation, as I told you, automation basically any industry that encounters repetitive tasks can use automation to replace repeatable process and march on the digital transformation path. So I hope that part is clear with you guys. So nothing much complicated from that aspect. Now let's move on to the financials. So first comes the income statement. So from this income statements, from the outside, you can clearly see that the revenues have been on a good increasing path, and the net income has also been increasing well. So even though you can see a small fall in the revenues here from the 2020 to 2021 period, you can see the income has increased. So the margins have substantially increased from the past. So if you calculate the income margins from the revenues, you can see they have remained around 17%. Here it fell down to 13%, but then it jumped to 26%. So the margins have drastically improved, which is a very good sign. So, and over the last 5 years, revenue has grown at an yearly rate of 21.4%, whereas the industry average was about 7.5. So the industry average, the main competitors of this firm are your other, the big firms like TCS or Infosys or even Happiest Minds per se. So these are the big competitions for this firm. And even though the industry average of revenue growth was 7.5, you can see this has outperformed it in that aspect. And over the last 5 years, net income growth has a yearly rate of 23% versus the industry average of just 15%. So as I told you, with increasing margins, obviously the income is also bound to increase. And the PE ratio is 26 compared to the Indian software industry average of 29.4. So PE is basically gives you a broad idea of the valuations and how expensive the firm is in the markets. So it is obviously saying if you blindly compare it to the industry average, this obviously means that the company is slightly undervalued, and it can be a good prospect and is trading at decent valuations. Now coming to the balance sheet. So our non-current assets means, for those of you who do not have a financial or an economics background, basically current assets means the cash in hand or liquid cash, basically anything which can be liquidated. And non-current assets are your fixed assets like your buildings or your other material assets. And total assets are just a sum of these. Current liabilities are the short-term loans, and non-current liabilities are the long-term loans. That is, I'm putting it very as simply as possible in layman language. And total liabilities, the sum of these both. So if you see, the current assets had been increasing. Current assets is the cash in hand, but in the last year it has decreased. Now let's dig deeper into why this has happened. If you look at the non-current assets, the fixed assets. So fixed assets were slowly increasing at a slow pace, but then in the past 1 year, you can see a huge jump from 61 till 153. So why is this happening? So what does increasing non-current assets means? More of investments into your fixed assets, right? So fixed assets, again, as I told you, are your buildings or your equipment, your computer equipment, or all the tangible assets. That part comes into your non-current assets. So that has jumped considerably. Now, how did this jump come here? You can see the non-current liabilities and the total liabilities. Liabilities are basically your loans, as I told you. So current liabilities are the short-term loans. So the short-term loans have remained more or less constant, But then if you see your long-term loans in non-current liabilities, you can see from a huge jump from 123 till 56.67. So this basically means that the company has taken in huge amounts of debt and invested in the company and is looking for so this basically means there is huge growth potential, right, as the company has invested hugely in itself by taking out loans. Now taking out loans is not necessarily a good thing, as we all know, but the company is also not giving out any dividends, so that basically means the earnings, whichever the company is making, the earnings or the profits, that is also being reinvested into the company for further growth. And that is also a good sign of a growing company or an expanding company. So that was the insights from the balance sheet you can take. And this is the cash flow statement. So for any company, the profits and revenues mean much lesser than the actual cash flow which is coming in, because cash flow is what will be put to use and not your income on paper. So you can see the free cash flow was positive. So positive cash flow is always a good sign for the company, but in the last 1 year it has turned negative. Why is this? Same reason here. So all the income is being reinvested to grow the assets. So why are you growing assets? So that you can grow your income as well in the future. So basically they are investing in themselves, and that is the reason, probably the reason why the cash flow has also turned negative from a net positive. And you can see a change in the working capital. So working capital is basically the salaries you're giving out to the employees and all the costs in the short term. So even that has increased tremendously. So this huge increase could also be maybe because of hiring in the workforce, hiring good employees. So those will add up to your change in working capital. And your capital expenditure, as you can see, 1, 4, 4 and 100. Capital expenditure again means expenses, right? So you're spending basically, and even this has hugely increased if you can observe. So all these are signs, and they are pointing towards a company which is investing hugely and has huge growth potential and could turn into one of the giants soon. So this is going deeper into the cash flow statement. Net change in cash is a part of these three: change from operating activities, investing activities, and financing activities. So what does this mean? I will try to put it as simply as possible for you guys. So change in operating activities, you can see, has increased tremendously in the last year. Now where did this increase come from? Change from investing activities. So investing activities has gone down from 12 to 84, whereas operating activities has grown from 20 to 92. So investing activities again basically means you're investing in yourself, as I've been repeating again and again. And this is this is reflecting in the increasing operating activities cash flows. So that is the simple, logic you have in this. And over the last 5 years, the market share has also increased from 0.36 to 0.68. So the percentages might be small, but if you see properly, it has almost doubled, right? And with the current scenario, with all these huge investments going on by taking on debt, if this goes in the right direction, which will completely depend on the management and also the environment, obviously, if the management succeeds in taking this on the right path, then this 0.68 could well turn into 3 or 4 or 5 in the coming few years. And that is what will help, obviously, the share price also increase exponentially. Now the shareholding pattern, if you see, the promoters have almost 54 plus 20, so that's about 65% is promoter holdings, and the rest is non-institutional holdings. And the retail holding is comparatively very less, but you can see that the promoter holding in the last 6 months and also in the last few years has remained constant. So that is a very good sign, as the promoters are holding on to their part of the company and are not giving it away. So that means they are confident in their own growth, and the promoters know more about the company than anybody else outside, right? So if they are confident, it is always a good sign. And now the risks associated with this, as I told you, it is a small company with a market capitalization of just 960 crores. So you can also consider it as a micro cap stock. So it is difficult for this small company to compete with a TCS. So a client who's going to TCS would not consider InfoBeans, right? A client who's going to TCS would probably consider, Infosys or HCL Tech, but not InfoBeans. So to grow to that stage, it's not an easy path ahead. And also the increased debt, as you know, with an increased debt, the interest also keeps compounding and multiplying. So even if there are 2 or 3 bad years in between and the cash flow is disturbed because of this, then this debt keeps mounting and mounting and mounting, and it would be difficult for a company to get out of a debt trap, basically. So that is one of the biggest risks associated whenever a company takes a big debt upon it. And these are the two main risks associated. As such, I mean, there are always a risk of environmental conditions in the financial environment, I mean, or a black swan event. But the main two company specific risks associated with this are these two. So now let's go into the technicals and see what the stock is doing. So if you see, the stock doesn't have much of a history, right? So it was listed on NSE recently in 2019, so it doesn't have much of a history. But in the recent past, you can see that it has tremendously gone up. So this was basically because of these investments I was talking about. So after seeing that, investors around these areas got a good, they saw growth prospects in the company and started investing here. And you can see currently the stock is just consolidating in a range. So every time it has consolidated horizontally, it has shot up. So it does look like a good bullish trajectory currently, but you never know, it may always come down, right? So currently trading at 400. Let's see where it ends up in a few months or years. So that's it for today, guys. Thank you for watching this, and please comment down below if you have any doubts regarding to this company. Please like, share and subscribe if this helped you. Thank you.